What's up guys, how's it going? Welcome to today's video. So in the previous video I explained to you a few reasons why you shouldn't buy stocks, and by the amazing response that I got on that video, and after that amazing response that I got on that previous video, I'm going to be explaining to you a few more financial instruments. And yes, I know there are hundreds of YouTube videos out there explaining the same thing. But the problem with them is they're just too long. They drag on for like 10, 15, 20, 30 minutes and they explain to you everything in great depth. But let's face it, nobody really cares, right? Everybody just wants to know the basics and just wants to know how to invest in them. And that's something that I think those videos miss. So today we are going to be talking all about bonds. I'm going to be explaining to you bonds in 3 simple questions. What the hell is a bond? Why should we invest in a bond? And how to buy a bond? So the first question, what the hell is a bond? A bond is essentially a way in which companies can raise money. See, companies need money to pay their employees, expand their businesses, and do other business stuff. There are essentially 3 ways in which companies get money. Number 1, they sell their stock. In this method, companies basically sell a part of their business in exchange for money. The problem with this method is that if you keep selling your business away for money, you'll soon have no business left. The second way in which you can get money is a bank loan. Now obviously in a bank loan you don't have to give away your company, but there are a few more issues involved. First of all, a bank will ask you to sign 500 documents and then they'll process your loan in approximately 23 years. And by the way, they'll charge you like 13% interest on it. Now obviously that's not desirable. So we come to the third way in which companies get money, which is bonds. Now what every company can do is create bonds and sell them in the open market to investors like you, me, and other institutions. Anybody can buy a bond. And generally the rate of interest on these bonds is like 8 to 9%, so it's better than a bank loan. Now we know why bonds exist, but what exactly is a bond? A bond is basically an agreement, a paper or an electronic agreement between the lender and the borrower. It basically has 3 important components. Number 1, the yield. The yield is basically the rate of interest that you will get on the bond. The second is the payment cycle. A payment cycle basically signifies when you will get the interest on the bond. A payment cycle can be monthly, yearly, half yearly, or cumulative. The third most important component is the safety rating. The highest safety rating is AAA and it keeps on coming down to like AA plus, AA, AA minus. And as you might have guessed, the safest bonds, which are the AAAs, have the lowest amount of interest. Now we come to the second question. Why should you invest in bonds? See, without bonds, there are 2 options. One is an FD, which is a fixed deposit. A fixed deposit generally gives you 5 to 6% interest and it's generally considered extremely safe. But the problem is 5 to 6% is very low. Sometimes 5 to 6% doesn't even beat inflation. The second option is stocks. Stocks generally give you 12 to 15% interest, but they are quite risky in nature and some people just don't want to get involved in the market. So bonds provide that sweet spot. The rate of interest is like 8 to 9% on it and they're not quite as risky as stocks. So I would definitely recommend you guys to diversify your portfolio and invest in bonds. Now we come to the third and the most important question. How the hell do I invest in bonds? For that, I'm going to have to take you to my laptop. So there's basically 2 ways in which you can buy bonds. One is directly. So I am on this website called goldenpie.com and here you can just go to discover bonds and it will list you a bunch of bonds here. So here you can see that I've sorted it by yield, which is high to low. And here we have a bunch of bonds. The first one is South Indian Bank. The yield is like 13.73%, which is pretty good. Then the payment cycle is yearly. So you will get your interest at the end of the year. And the call date is 2025. So this bond exists till 2025. And here you have the safety rating. The safety rating is pretty low. It's A minus, so this one is quite risky. But as you can see, like the more the risk, the more the yield. But the main problem here that I see is that the minimum investment amount is sort of just too high. I mean, 2.5 lakhs, 10 lakhs, like I don't think anybody my age is going to invest 2.5 and 10 lakhs into bonds. So the actual way in which you can buy bonds directly is when they IPO. So here you have Dhani Loans and Services and it's IPO is like currently ongoing. So here you can see that the minimum investment amount is 10,000 and the yield is like 11%. So this is pretty good. The safety rating is also pretty good, and the payments that you'll get is cumulative. So cumulative basically means you'll get all the interest and the principal amount back at the end of when the bond ends, and the tenure is like 3 years. So after 3 years you'll get all your interest and your principal amount. Alright, so the second way in which you can buy bonds is through mutual funds. Now what mutual funds do is that they buy a bunch of bonds and then you can sort of buy into their fund. So I am currently on Coin, which is a Zerodha product, and this is my favorite product to buy mutual funds. And here I'll go to the debt category because bond is debt, and you can choose any one of them. I'll just go for corporate bond right now. Here you can see that there's a bunch of funds here. I'll just open the first one. So here you can see that this is the HDFC corporate bond fund, and the minimum investment amount is 5,000, which is pretty good, and the CAGR is right now 4.19% for the last 1 year, which is pretty low to be honest. But if we switch it to like 2 years, it's almost 8%, which is not bad, and 3 years it's almost 9%, which is pretty good. So here you can see other stuff like there's the risk involved is moderate, and if you go even further, you can actually see the bonds that this fund holds. So here you have Government of India bonds which expire in 2026 and 2027, and this is the interest rate here, 6.97%. And yeah, it also holds obviously some corporate bonds, which is Ultratech Cement and Bajaj Finance, etc. So here this website is pretty good. It'll show you everything about the bond. With that, we come to the end of this video. Thank you so much for watching. Hit the like button, hit the subscribe button, and comment down below if you have any questions or if you have any suggestions in general. Yeah, this video is now over.